Welcome to the Bryan Foltice Behavioral Finance Podcast, where we unravel the mysteries of behavioral finance and unlock the secrets to making smarter, more informed decisions with your money. Now, here's your host, Dr. Bryan Foltice.
Welcome, everybody, to another edition of the Bryan Foltice Behavioral Finance Podcast. Today's topic is going to be back to basics, talking about behavioral finance concepts, giving an update on prospect theory, a review on that, and then diving into the application, which I want to talk about today, and that is called the disposition effect. And so thank you very much again for joining in. We are filming or recording today in my office in summer mode, so I'm starting to leave the past behind, the previous academic year. I still have my online course that I'm teaching, and so I do have those 41 students here this summer that we're in the middle of corporate finance that is online. But this is also now time for me to really dig in and create some content around all of the ideas and the behavioral finance concepts that I've been itching to share with the world. So happy to be here, happy to be moving the needle forward. So hopefully this is more a beginning of more to come over this summer as we really push on this topic and making it more accessible and applicable to people. So today, the disposition effect. I was going back this week recording the course that I've been teasing you about over the last few months, the Introduction to Behavioral Finance, where we touch on how we actually make decisions compared to how we theorize in neoclassical finance and economics. And so we distinguish that, and then we also talk about our prospect theory. We do a deeper dive into that, really tackle it, and then also put in the application to the world around us around prospect theory. And part of if you go back to previous episodes, I've touched on that in just a very workshop-like, that's what I use this podcast for, to workshop a lot of the ideas, and then I kind of formalize it and bring it into some of the course content. Well, part of the application that we talk about in prospect theory is we have our reference point on which we base our gains and losses off of. We also have loss aversion, that we feel our losses more than we feel our gains. And we've said that average investor usually is about 2.25 times. And if you're above 10 times, this is hyper loss aversion. We actually have something that is called diminishing value sensitivity. Diminishing value sensitivity on both gains and losses. So what that means is the first gains are felt stronger. And expected utility actually captures this with our natural logarithm, where it states that not all dollars are created equal, which means if I gave somebody with $0 $10,000, they're going to be a lot happier compared to somebody who has $1 billion getting that additional $10,000. And so this diminished value sensitivity is actually quite applicable. And so we see that in the gains, happiness first, those first gains, and then diminished value sensitivity after that. We kind of become a little desensitized to it. On the loss side, we know that it's a very steep hurt, pain felt when you incur those first losses. But then you have a flattening after that. As you incur more and more losses, your pain subsides. You still feel the pain. It still goes negative, but it diminishes and so the diminishing value sensitivity on both gains and losses are captured with prospect theory. We define the disposition effect as our tendency to sell winning stocks too early, and we tend to hold our losing stocks for too long. And so we want to try to disentangle, like, what's happening here? Why do we do this? Well, start with yourself. Think about if you have a stock that you've purchased and you have a gain. You got it at $100. It goes immediately up to $120. That feels really good. And think about how you feel. Now you feel good because you've gained money. You probably feel really smart. Now you feel like, hey, I'm just have extra knowledge over the market. So we start to have these thoughts. But then, and this is our utility function where we feel that gain, it feels really good. But then you start to question, you go, I kind of want to lock in this feeling. And it could continue to go up. And that's where this momentum theory kind of comes into play. It could continue to go up, and by selling it, you're going to lose out on that. However, the psychological part of selling too early these winning stocks is that you get to lock in your happiness and your satisfaction. So you might be giving up on future gains, but you've locked in your happiness, and that's what many people do. How do we explain holding our losing stocks for too long? Well, let's now re-examine that loss side. We feel the losses, it sucks, it hurts. But then after that, we go, well, I'm not feeling so smart. I'm not feeling so good. In fact, I really hurt going down and losing money. So now it's sitting at 80, and you hold on to this little hope that maybe it'll come back. Maybe I can get this good feeling and I'll get back into the gain domain. But because I've already experienced all the pain, there's just not much left over. Now my diminishing value sensitivity kicks in, and you go, you know what? If it goes to 60, it doesn't really matter. I've already incurred the pain. And now, as I quote George Costanza from Seinfeld, you know what? I'm going down with the ship. And he's already experienced the losses. I already felt it. Now I don't feel anything anymore. I'm going down with the ship. And we end up holding the stocks for too long because we'll just let it ride down to zero. And we've already experienced the emotional pain and anguish around it. And we're just holding on to a little hope that maybe it comes back. And so we end up hanging on to these losers for too long. Or if you're like me, sometimes I had to learn this lesson the hard way. They say, don't try to catch a falling knife. And I always tell my students about Wachovia Bank back in the financial crisis. And I always liked Wachovia. It was a personal bank. I had my bank account there, and I always enjoyed the people. And so, of course, like a naive investor, I just think, well, of course I should invest in this bank. And so I bought it at 40. And when it went down to 20, I thought, oh, great, this is on sale for 50% off. So I felt the losses. I didn't get out. I just doubled down on my position. And of course, when I ask everybody in my class, how many of you know Wachovia Bank? You get crickets, and that's because Wachovia Bank went bankrupt. So again, I can definitely attest to these behavioral aspects of holding your losers for too long, or if you're like me, adding to your position when you are losing money on it. So anyway, we understand this tendency, and we found this was back in 1998. This is Terence O'Dean talking about are investors reluctant to realize their losses. And so he goes back and uses some retail investor data to show that their disposition effect is alive and well. And then there's some subsequent follow-up showing that, yeah, investors are really underperforming because of this psychological tendency to sell their winning stocks too early and to hold their losing stocks for too long. And so if we can identify what is going on here, that's fine. But what I'd like to do is I'd like to look and see, is there a way to eliminate or reduce this effect in our own trading world? So once again, I'm thinking about a strategy that can eliminate emotion from this trade and not take a full-time job to actually execute. So what we thought about is, what if we used trailing stop loss orders? If we use stop loss orders or trailing stop losses, would that actually minimize or reduce our disposition effect? And so there's a couple of different ways that we approached it. I recently went with my colleague, Steve Dolvin, and we published a paper in the Journal of Beta Investment Strategies last spring. And we just looked to see if we could do ETFs, exchange traded funds, some of the broad-based. This is our SPY, our QQQQ, which is NASDAQ, and the diamonds, which is the Dow Jones. We also used about 9 sector ETFs, the old spider ETFs, and we were testing this to see if trailing stop losses would actually work. And we actually found that if you use a trailing stop loss of about 1 standard deviation, so not all stocks and not all assets move the same way. Historical volatility, if the historical volatility of the S&P 500 is approximately 17%, well, then we multiply that by 1 or 1.5, and we'll say, hey, let's make our trailing stop loss around 20 to 25%. And found that can actually historically provide higher excess returns. So this is higher returns after factoring in risk. And found that pretty interesting. We found the same thing for a lot of the ETFs as well. But now going back to trailing stop losses and minimizing the disposition effect, we can look at, all right, what happens if I buy a stock at $100 and I put a 20% trailing stop loss in place? And for most discount brokerage firms here in the United States, I can place a good till cancel order that lasts between 60 and 90 days. Set it and forget it, or at least for 2 to 3 months, set it and forget it. And put it in at 20%. So immediately, if the stock were to go down by 20%, or whatever threshold you choose, then it will stop you out. And if it hits 80, your order becomes a market order. So you become a participant, you become a seller in the market, and you get the next available price. And then, of course, if you set a trailing stop loss limit order, once it hits that trigger of $80, then it becomes a limit order, which you can say, give me at least $80. So if it goes below, it has to come back. It triggers at 80, but if it goes below, it has to actually come back above 80 for your order to fill. So what that does on the downside, if it were to immediately go down, you buy something and it immediately tanks, it triggers you out. And that helps mitigate our holding our losing stocks for too long. So now I'm going to cut my losses and get out before I start going through this whole going down with the ship ordeal. But what happens on the gain side? So imagine now you buy the stock at $100 and it goes up to $150. Well, your trailing stop loss trails you by 20%. So if it goes up to 150, trailing stop loss follows behind by 20%. So if my math stands correct, trailing stop loss triggered then becomes 120. If it continues to go up to 200, your trailing stop loss follows you, and that's 20% behind. That's $160 is your trailing stop. And so what it's doing, as long as that wave, you're riding the wave, that trailing stop loss will follow. So if it goes up to 200, it has to fall below 160 before that is triggered, and then it becomes either a market or a limit order. So what that does is it actually helps, first of all, eliminate emotion.
Thank you for tuning in to another episode of the Bryan Foltice Behavioral Finance Podcast. We hope you found our exploration into the fascinating world of human behavior and finance, bold and thought-provoking. Be sure to subscribe for future episodes. And until next time, stay curious and financially savvy.
So anyway, you can see, though, that this could be a very effective use to minimize your disposition effect. And we found this we're starting to get more and more literature that are proving this in an experimental lab. It's really hard to try to get in and check investor behavior, but we've done experiments. There's some new, I would say in the last 5 to 7 years, experiments that have put people in the lab and has tested this disposition effect and finding that these trailing stop losses do help mitigate and even eliminate some of this disposition effect with investors. And I think that is my take-home message to you as we're investing out here, is to really jump into some of these strategies. Keep an eye open for the Introduction to Behavioral Finance course that is coming out. If you want to reach out to me, you can find me on LinkedIn, Facebook, Dr. Bryan Foltice, and YouTube. And then also bryanfoltice.com. That is BryanFoltice.com. And I would love to hear from you. Otherwise, hope you have a great rest of your week, and we'll talk to you on the next podcast. Thanks, everyone. Bye.